So that's what makes it so interesting to me, that I'm owning the exact same securities that we all chase and we all hear about in the news and that make all the stories up. I own them, but I own them in an environment where they're paying me all the dividends, all the returns, all the capital gains are coming to me, 95% of them, and not going back into the business, so to speak.
On this episode of Early Bird, Steve Selengut, a retirement income coach. Steve joins the podcast today to talk about closed-end funds, including the pros and cons of these types of funds for investors. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you how you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, Steve, welcome to the Early Bird podcast. How are you doing today?
I'm doing fine.
Great. Today we are talking about closed-end funds and what it means to the stock market here at the end of 2023. But before we get to that, Steve, in about 30 seconds or less, if you could explain who you are and your background to our audience, what would you say in 30 seconds or less?
I've been a professional investment manager pretty much all my life since 1979. I've managed, when I sold my business last year, I had 110 million under management for about 145 different clients, mostly in the United States, but some abroad. My focus with these people, as I've pretty much brought them like myself from their 30s and 40s into retirement, was to create a income environment for them where they'd be income independent. They'd never have to look around and can I do this or can I do that? Their income always exceeded their anticipated expenses.
And that's good for with that background. You're able to take a look at the types of investments that certain investors may want to go after, especially those who want income. And certainly one of those options, Steve, is the closed-end funds. Real quick, let's talk about what a closed-end fund is. I'm sure our investors are familiar with, the listeners to the podcast are familiar with what a mutual fund is and how it operates and how it's a collection of different types of investments. But what specifically, and real quick, what is a closed-end fund?
The basic, the most interesting difference is, first let me tell you what the basic similarity is that they both contain almost exactly the same securities. If they're stocks, the same stocks, the same bonds, the same mortgages, the same everything. The difference is that the structure of a closed-end fund is that it's a trust vehicle, meaning it's just like a stock. And it's the way it's designed legally, it has to return to its shareholders 95% of the income it generates. A mutual fund doesn't do that, nor do the stocks that are inside the closed-end funds. So that's what makes it so interesting to me, that I'm owning the exact same securities that we all chase and we all hear about in the news and that make all the stories up. I own them, but I own them in an environment where they're paying me all the dividends, all the returns, all the capital gains are coming to me, 95% of them, and not going back into the business, so to speak.
That's wonderful. That's a good explanation of what it is. And these closed-end funds are available to all investors in the market. Anybody can invest in one, purchase one, pretty much. Before we get to a look at these funds in 2023, let's talk about the advantages of investing in a closed-end fund. You talked a little bit about that, Steve, regarding what you get as an owner of these funds. But in a nutshell, let's talk about that. What are some of the
Well,
advantages of investing in a closed-end fund versus just a traditional mutual fund?
well, they have the same benefits of diversification, certainly. The key element, unlike a mutual fund, which is not traded during the day on the exchange.
Hmm.
So if the price, let's say we have one of those 500-point rallies, um, you can't take advantage of that and take a profit in a mutual fund. You have to wait until it opens the next day, really, to sell it. Closed-end funds trade like stocks on the market. You can buy them and sell them anytime you want. Um, but the principal difference, I think, like I said before, is the extraordinary amount of income they pay. If you were to look at 100 different mutual funds, you'd find that the average yield is somewhere in if I'm being generous, saying between 3 and 3.5%. I have a selection universe of 200 of closed-end funds that the average yield right now is roughly 10%. So
Nice.
that's the key difference to me. Um,
Yeah, it sounds like a great vehicle for income potentially, and of course for all of our listeners, this discussion is just for entertainment purposes only. Definitely speak to your financial advisor before making any investment decisions. You mentioned, Steve, that a closed end fund trades like a stock.
yes.
When I hear that, what comes to my mind is an ETF or an exchange traded fund. So what is the difference between a closed end fund versus an ETF that most people are familiar with?
Okay. Other than the same type of difference in the yield that they have, the other difference is that there is no attempt, just like a stock. When you buy Amazon or Exxon or any company, there's no relationship between the stock price and the book value of that company.
Hmm.
ETFs, on the other hand, when you buy them, they are traded at or close to their net asset value, and every night or every morning, whatever, the number of shares that are available are adjusted to make the net asset value equal to the price. This is not done in closed-end funds. You can actually buy a portfolio full of mutual funds today at a discount from what their actual net asset value is. So that's the key difference between the two. There's no attempt to make net asset value and share price the same, just like in the real stock market.
Interesting. And so closed-end funds, we talked about those advantages. Obviously, it's great for income, and there are other benefits that go along with investing in them, but there are also some risks. There are disadvantages. Steve, what are some of the disadvantages of investing in a closed-end fund?
And this may be a surprise answer. They are interest rate sensitive securities. I think most of your listeners know that high dividend paying stocks like utility stocks, for example, are very, very sensitive price wise to expectations about interest rates. Closed end funds triple that sensitivity. They are so sensitive. So as interest rates have risen, the prices have gone down. The element, though, that's important is that the securities inside don't change the amount of dividends or interest that they pay just because their price is lower. They're contractual. And most stocks, also in closed-end funds, they have not reduced their dividends during this period of high interest rates and low stock prices either. So the income remains the same, but the price goes down to reflect the nature of interest rate sensitivity. I liken it to the scales of justice. If interest rates are expected to go up, prices go down. If interest rates are expected to go down, prices go up. And that's going to happen. That's going to happen with any interest sensitive security.
So the issue here is interest, and that certainly is a disadvantage potentially with a closed-end fund. Well, what about leverage? Closed-end funds, I'm told, also use leverage at times, and isn't that also a risk with investing in them?
It it's no bigger risk than when a stock company goes out and borrows money to build a new factory. Instead of building a new factory, the manager of a closed-end fund is buying more securities, and he's not going to borrow money at 3% if he can't invest in securities that are paying more than 3%. I mean, he's a manager. It's not a robot here. We've got a manager. Just like when interest rates were just 2 years ago, when interest rates were near zero, many of us went out and looked at um, you know home loan line of credits because we could borrow money at 2% and invest it at 10%. So it's the same relationship. It's risky to borrow money. It's more risky to borrow money, I'd say, in the regular capital markets than it is for a closed-end fund manager. He doesn't have to borrow money if he can't get a better yield. Whereas somebody who's running a corporation, he's got to borrow money if he wants, sometimes just if he wants to pay his employees. So it's a big difference. A lot of people think that risk makes them go down more quickly than other types of security. But that's really interest rate expectations at work, as opposed to the short-term borrowing, really.
Good to know. When we return, we'll hear from Steve about the top closed-end funds to watch out for in 2023. But first, let me tell you how you can become a more informed investor through Early Bird, a free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, Steve, today we are talking about closed-end funds, and we've already discussed the pros and cons of investing in them. Let's talk about closed-end funds in 2023. I'm sure there are several that you can talk about right now. I'm curious to see how those closed-end funds have performed versus the larger market. The Nasdaq, for example, is up 35% this year, and the S&P 500 is up over 17% so far. What are some of your closed-end funds that you like to keep an eye on in 2023, and how have they performed versus the larger market?
Well, let me say one thing first. Although the S&P and the Nasdaq are up this year, certainly, they're still behind. They're still below by 5% and 10%, respectively, their all-time high in January of 2021. Mm-hmm. So yes, they're up. No, they're not. Closed-end funds are not up this year, not at all. And however, they're still paying all the income. So we've been adding 10% to our capital base for these 2 years, okay? Thus, and reinvesting that 10% at 10%. So we've been growing the capital in our portfolios at a high rate where the stock market is still below where it was over 2 years ago. Oh, and that's performance. That's performance. People who are in the stock market over this period of time, and I'm sure many of your listeners are not retirees, but they're all aware of the premise that 4% is what you're going to be taking from your portfolio when you retire. That money has come out of selling securities because the market wasn't going up 4% per year. So they've been dipping into capital for 2 years, whereas closed-end fund investors have been adding to capital during this 2-year period. So capital has grown. And for me, that's kind of performance that I'm looking for. I'm looking for growth in income and growth in capital. And as one ages, those things become more and more important to them.
I see how that could certainly be important to an investor. What are some of your favorite closed-end funds that the average investor should definitely consider. Here we are, late 2023.
Okay.
What are some examples that you have?
Okay. I'm gonna talk about mention the three examples that I included in my book.
Sure.
And can I mention the name of my book?
Sure.
Retirement Money Secrets. It's available any place you buy books, and it talks about, it is a CEF based methodology, but there are three of them, and two of them are focused on income, and one is focused on equities. And I'm looking at the chart of KIO, which is one of them. And this is, I'm not recommending KIO. This is out of a book that was written a year ago. And I'm just saying that if you look at their distribution history over the past 10 years, the distribution has almost been the same every year, except in 4 of those years where it paid extra dividends. Okay. Similarly with Gabelli. And Gabelli is a big company. Everybody's heard of Mario Gabelli, I'm sure. His company specializes in closed-end funds, and he's one of the biggest number of closed-end funds in his company. And this is an equity fund, and over the last, actually since 1993, the total income it's paid out each year has gone down a little bit from a 26 cent distribution to maybe an 18-cent distribution over those years, mainly as a result of, during that period of time, the interest rates were so low, actually. But it's paid special dividends on 15 occasions to make up for the difference. And then the third one I had in the book was a corporate bond fund called, it's PIMCO, and PIMCO's another household name, right? In the investment business. BlackRock is another one, First Trust Company. A lot of these major companies operate closed-end funds and never advertise.
Yeah. And the third one is what?
And the third one is PCN, PIMCO Corporate and Income Strategy. And this one, if you go to a place called cefconnect.com, you can study the 400 or 500 different closed-end funds. And this one has paid the same base dividend since 2002, and on several occasions has paid extra dividends as well, and that's from a bond fund. So if you look at the overall risk picture of securities, I think everyone knows from basic economics and business management that on the risk ladder, corporate stock of a company is more risky than corporate bonds of the same company. So here we have a bond portfolio that's paying extra dividends because the bonds are doing so well. So this is the kind of performance that over the long run, if you look at the long run gains in the S&P or the NASDAQ or even the Dow, you're not going to see 10% averages. You're going to see maybe 5 or 6% averages in the long run of growth in market value, and that's including the dividends that are paid by the stocks inside. Whereas the same record for closed-end funds is much higher.
I see.
If I can give one more example, if you'd like, and
Sure.
It's in the book as well. We took a portfolio of just 10 closed-end funds, which also is not a recommendation. And we compared it with both SPY, which is the S&P 500 index fund, and BND, which is the one of the big bond outfits. And in 3 measures, market value growth over a 20-year period, amount of capital depleted over a 20-year period, and the third one was total payments, total income received. In every one of those, the CEF portfolio outperformed the stock or the bond portfolios themselves by a wide margin. And, it's very clear in the long run span of things that an income focused portfolio is going to do better. And the excitement is stock. Don't get me wrong. I grew up with stocks. I mean, when I got started on my own portfolio, I mean, I had a portfolio of stocks that I grew and grew and grew until I pretty much retired and started my own business when I was 34 years old, because of my trading in the stock market. And I owned all those. At that time, there was no tech sector except for IBM, okay, and GE. Those were the tech giants back in those
but
days.
Stocks were still. I get it. I totally get it. The stocks were just still important at that time. You're saying.
Right, and they're every bit as much as important today. But I own them. I still own them. They're inside these closed-end funds.
Interesting.
If you have a small portfolio, let's say you're just getting started and you've got $20,000. That's your investment portfolio.
Oh wow.
You can't go out and put it all into one stock. That would be foolish. And if you spread it around between 10 stocks, then you have such a small amount invested that even if it goes up 20%, you're really not going to make out, and it's not paying you any income.
Good point, Steve. Excellent point.
You can own them all in a couple closed-end funds and be diversified and have the income coming in as well, and plow back that income, and you're compounding your interest, and we all know how much compounding interest is in a factor of growing.
It really is
growing wealth.
Steve. Thank you so much for sharing your thoughts about closed-end funds and what investors should look for, giving a few examples. We really do appreciate that. Really insightful. Before we wrap up today's podcast, I just have one final question for you, Steve, and that's the most important question for today's discussion. That question for you, Steve, is if you could instantly become an expert in something, what would it be?
Making women happy 100% of the time after 50 odd years of marriage.
That would be a great thing to be an expert in, of course. Thank you again to Steve Selengut for sharing your insights on closed-end funds. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.